if you cannot see where liquidity is on the chart of any asset you're trading, ladies and gentlemen, you are most likely going to be the liquidity if you dare enter that market. So in this video, we are going to talk about everything liquidity, how to see it on any chart, and how you can use it to trade successfully in the market. Are you ready? Let's dive right into this. So ladies and gentlemen, what exactly is liquidity? I know people these days use fancy terminologies to define liquidity. People try to make it look complex or even more complex than it is. Actually, what liquidity is money. Liquidity is simply money in the market. All right, money that is available in the market, and that's what liquidity is. And market will always move towards money. Don't forget this. This is like a rule, okay? The chart, when you look at the chart of any asset, the price would always move towards money. All right, so what I'm going to be doing, as I said earlier, is to help you see where liquidity or where this money could be located on the chart of any asset. Okay, so what are the types of liquidity? All right, or you can say, where can we see liquidity on any chart? Where can we see it? You can see liquidity at a number of places on a chart. When the market is in an uptrend, it moves like this. All right, don't forget we already did an episode on market structure. All right, and in that video I explained what it means for the market to be trending. All right, so this right here is a trending movement. This is an uptrend. If you have not seen that video, please check the description of this video, because we're going to be combining the concepts in that video, the concept of market structure with the concept we're learning here, liquidity, to figure out how to predict the market or react to whatever the market is doing. All right, so if the market is moving like this right here will be higher high. All right, but now we are talking about liquidity. All right, liquidity. So these peaks here will be our swing highs. All right, and these ones here will be our swing lows. So at these swing highs and swing lows, we have money sitting here. So at swing highs and swing lows, we have money around these regions. All right, so some people call it swing high and swing low liquidity. So you would always see liquidity at every swing high and swing low. Money would be resting around this region. Now you might be asking, why would liquidity sit or rest at these zones, at the swing highs and swing lows? Well, the answer is pretty simple. At this point, for example, there will be people, traders, shorting the market, and they would have their stop losses above this swing high. All right, so that's why we say that liquidity sits at every swing high. They would have their stop losses, all right, at that level. And when it gets here, the people buying here to push the market to this level would have their stop losses at this level. All right, so that's what is happening here. There is always a buy order. All right, there are always buy orders at these swing lows and sell orders at these swing highs. All right, and of course there will be stop losses below those zones. And as I said earlier, the market will always move towards liquidity. I'm going to come back to this again because it is going to lead us to a very important concept. So we could have liquidity at equal highs and equal lows, equal highs slash lows. All right, so some people call it equal highs and equal lows liquidity. What does this mean? Let's say the market moves like this, retraces, moves up again, retraces, and moves up again. Notice there is a floor here that the market seems to be struggling with. All right, this is what you call your support level, right? So there seems to be a support level or a temporary floor that the market is battling with. So this right here is what we call equal lows. All right, because the market is struggling to break this region. There will be liquidity sitting around this zone. All right, so of course, as I said earlier, the market will always move towards liquidity. I'm going to explain what I mean by this statement. And we can also have another scenario in a downtrend when the market kind of moves like this. The market can move like this, all right, and then retrace, move like this, retrace, and continue downwards. All right, don't forget this direction was up. So say the market was in a downtrend, all right, you can pull back again, create this right here. So what we have now is a resistance level the market is battling with. All right, so you would have liquidity sitting at these levels. Again, you might be wondering, why would liquidity sit at this level? The answer is pretty simple. When buyers buy at this level, all right, they will have their stop losses below this level. All right, the market would move up and come back down, and of course the people who bought here also would have their stop losses at this level. All right, so they have stop losses at this level. So what would the market do when there is liquidity sitting at a zone? All right, whether we are talking about whether you're talking about swing highs or swing lows, or equal highs and equal lows liquidity, what would the market do? The market would always move towards those liquidity to grab them. All right, and that's what we call liquidity sweep. So now we are talking about something very important. All right, liquidity sweep. So let's come back to this right here to help you understand what I'm talking about. Let's say the market starts and moves up, all right, pulls back, and then moves up again, and pulls back, and then moves up again, creating this equal low liquidity. That means we have money sitting at this level. What the market could do is to reverse, because I said the market will always move towards liquidity. Now notice what the market has done. The market has gone below this level right here, this level, right? We had money sitting below, so the market had to go below it to grab all the money here. And when it grabs it, what do you think it would do? The market will reverse and push probably towards that direction. So this right here is what we call a liquidity sweep. When the market moves, all right, in such a way to grab all the money in a particular direction. All right, and if we had the market moving downwards like this, ladies and gentlemen, and what happens, that's in a downtrend, and then the market pulls back, creates these liquidity zones, all right, here. Now the market moves as if it wants to continue downwards. Notice what is happening. We now have these levels right here. We have liquidity at this level, right, sitting around this zone. The market would most likely move above that level to grab all the money around here, and after that, what would the market do? The market would reverse, all right, and continue in the downward direction. That's if the market is already in a downtrend. All right, the market would move up, grab all these equal high liquidity, all right, and continue in the downward direction. Of course, sometimes it could reverse and continue in the upward direction. So another one is a trend line liquidity. Say we have a line like this, and the market is just bouncing off this line, failing to break this line like this. This is what we call a trend line. Of course, this is a trend line when the market is in an upward direction. All right, so you would have liquidity sitting below this trend line. All right, ladies and gentlemen, and sometimes when the market breaks this line or sweeps the liquidity, all right, it would sometimes come back into the zone, right, to create a fake out. This would be a fake out because there will be a lot of people, trend line traders, who of course understand that when a trend line breaks, the market could probably continue in the downward direction. They will be trapped if they short the market from here, placing their stop loss orders above. The market could reverse and continue in the upward direction. All right, so see, this is what we call a fake out. because the market kind of pretended as if it wanted to break this trend line and continue in the downward direction, right? But it reversed and continued in the upward direction. It doesn't always happen like this. After the trend line break, the market could continue in the downward direction. It does happen like that. But a good way to get into a trade like this would be to maybe wait for a retest of this level. You wait for the market to pull back to this level, all right, and after that, maybe the market continues like this. So what this means, therefore, is that you've waited for the market to retest this level before shorting the market. Say you wanted to short the market. If you want to short the market and you've not gotten a retest of this level, or probably a sweep of liquidity, all right, a sweep of liquidity, this support level. When I want to trade trend lines, I don't trade them often, but if I want to trade them, I would wait for the market to pull below the trend line, and I will look for a support level, a reasonable support level around this region, and then I'll wait for the market to come back up, all right, sweep liquidity, and then continue in this direction before I would consider getting into the market. And of course, we have support and resistance traders, all right. When they see the market moving between a support and resistance, they obviously know that the market could break out of this support and resistance, all right. They obviously know that market will break out. So above these levels, there will be liquidity here, and above here there will be liquidity here. So the market would always, all right, or most times, break out of these levels in order to sweep liquidity. So let me show you this on a chart. The first thing to do when you come to any chart is to identify the trend of that market. That's if you want to figure out the liquidity in the market. Please identify the trend. We can see clearly here that this market is moving upwards, all right, because we can see higher highs, all right. These higher highs are kind of higher than the previous ones, all right. So the market is trending upwards, like you're climbing a flight of stairs, as I would always say. Once you figure that out, the next thing to do would be to look for the liquidities I was talking about. So I want you to pay attention to what is happening around this region. So let me have it zoomed in. Now this was like what I was explaining earlier on, all right. There was a temporary retracement around this region. The market was kind of like sloping downwards, all right. So notice what happened. There was a pullback to this level, which means there is liquidity around this level. Notice what the market did. The market moved in the other direction, but notice this level here, all right, couldn't go below this swing low here. This level couldn't go below this level, which means there was no liquidity sweep. There was no liquidity sweep. But notice what the market did. The market went above this level here. That's a sweep, ladies and gentlemen. Sweeping all the money here. Let me show you what I'm talking about. So, ladies and gentlemen, around this level, we had a sweep of liquidity. Can you see it? The market obviously pushed above this level. The reason it pushed above this level with this green candle, all right, was because there were stop loss orders, all right, around this zone. The market went above it, grabbed all of that money, and what did it do? It reversed. Now let's see what happened when it reversed. It reversed and intentionally went below this level right here. It went below this swing low, and also went below this swing low right here. To do what? To grab all the liquidity seen around this zone and this zone. So this is what we call a liquidity sweep. Do you not see what I mean when I say that the market will always move towards liquidity? So let's zoom this in so you can actually see what I'm talking about. So if you look very closely, you can see that with this red candle here and with the wick of that candle, all right, it went below this level and this level. All right, so that means all the stop loss orders here we are already grabbed by just that candle that went below all of these levels, and that's what you call a liquidity sweep, ladies and gentlemen. Liquidity has been swept. So traders who understand the concept of liquidity and would want to get back into the market, maybe to buy, they would wait for a liquidity sweep to happen. All right, so in this first move, this liquidity had not been swept. They would wait for this liquidity to be swept, and that was what happened here. Notice after sweeping this liquidity and sweeping this liquidity, this is what the market did. The market actually decided to continue in the upward direction because the overall movement is in the upward direction. So liquidity had been swept and there was no need to continue downwards. All right, so notice what I told you earlier on. It was we are in an uptrend. Notice this was just a pullback. All right, so this push down here was just to sweep all of this money, and it also happened here. Let's kind of zoom it in again so you can see what I'm talking about, ladies and gentlemen. You can see that the market was moving and then kind of got towards this level. All right, notice what happened here. It pushed up, came down, created liquidity here, of course, created liquidity here, pushed up, couldn't induce this level. It couldn't sweep the liquidity, but it knew what it was doing because it must always sweep liquidity. The market was swinging, created liquidity here, and the market went back down. We have not had any sweep of liquidity. Pay attention. From here, liquidity building here, liquidity building here, liquidity building here, no sweep yet. That is what the market did. From here, the market went down, swept all of this liquidity here, all the structural inducements here, all the structural liquidities here. This spike, all right, swept all of that money, and what happened after that? The market moved up. Now let's look at how you can use the concept of liquidity we just talked about, and something like POI. POI means point of interest, to start predicting the direction of the market. Very, very important. So what is POI? Again, POI means points of interest. If you are an ICT trader, there are a number of points of interest or institutional reference points. I'm going to use order blocks, all right, and I'm going to combine it with the concept of liquidity to show you how you can predict the direction of any market. All right, so the other ones, I'm probably going to show you how to use them with liquidity and other concepts, all right, to predict the market. So make sure you are subscribed to this channel. We're going to be dishing a lot of value. Make sure you're subscribed, all right, and turn on your notification bell. Very important. So what is an order block? An easy way to understand it without fancy definitions is when you look at any chart, all right, and you see the market moving up like this, all right. The last red candle here at the swing low that caused this move to the upside is what you call an order block, and in this case this would be a bullish order block. So the last red candle here, all right, the red candle here, red, that caused this move to this upside. Notice this move led to a break of structure. All right, we had a break of structure. We also had a break of structure here, break of structure, break of structure. So the market was breaking structure, which means it was moving up. This red candle here, ladies and gentlemen, would be your order block. So you would draw out maybe a rectangle, all right, to indicate this zone as a very important zone, and it would be an important zone you would be expecting price to come to, ladies and gentlemen. And we can also have a bearish order block, right? A bearish order block would look something like this. So the market was coming down and then it pulled and then up a little bit, that is a retraced, and the market went down, and maybe so this level right here, the last green candle here, that green candle here, all right, where this move to the downside originated would be your bearish order block, ladies and gentlemen. So in a bearish scenario, we're looking at the green candle here. So we're looking at this green candle. all right, this green candle here. So how do we use this with liquidity? All right, remember there must be a break of structure, as I said. So now you can see we're combining it with market structure. We are looking at a break of structure. All right, so there's a break of structure here, there's a break of structure. So when you notice a break of structure, that means this right here was able to push the market down. Right, now let's look at how an order block looks on a chart. Here I've got a number of order blocks marked out. We have a bullish order block here, a bullish order block here, a bearish order block here, and a bearish order block here. Let's start with this. Why is this a bullish order block? Now notice here is a swing low, all right, and immediately after this low here there was a sharp move to the upside. Okay, the last red candle, I'm talking about this red candle here, before this bullish move to the upside. So after a swing low, all right, the last red candle before the bullish move to the upside, that's where your order block is. All right, just mark it out. And this order block led to a break of structure. Pay attention to that. It is very important. There must be a break of structure before you consider it a valid order block. All right, and we also have another order block here, ladies and gentlemen. Can you see from this swing low there was a move to the upside? There was a move to the upside. All right, so I picked the last red candle there. Can you see it? I marked the high and the low of that candle, and we can see here that there was a break of structure. So that move to the upside led to a break of structure. So we have an order block, a bullish order block. All right, so let's look at this these ones here where we had bearish order blocks, ladies and gentlemen. The last green candle before this bearish move to the downward direction, that's your bearish order block. All right, so just mark out the last bearish candle, pick the high and the low, and draw out your rectangle. You might be wondering, why do we extend the rectangle outwards? I'm gonna explain that when we start talking about how to combine order blocks with the concept of liquidity to try to predict the direction of the market. All right, so pay attention. This move led to a break of structure. So let me show you. Let me pick this. This low here was broken. So your order block should lead to a break of structure. And we also had another order block here, ladies and gentlemen. There was a sharp move to the downward direction. The last green candle before that move, that's where we have an order block, and that move to the downward direction led to a break of structure. All right, and where do we have a break of structure? We have a low here. This low was broken, so this push pulled back a bit, still pushed down and caused a break of structure here, ladies and gentlemen. So we have an order block, and that's a bearish order block. Now I want to show you something important about an order block, something you might want to expect from an order block. Let's look for another order block example. Now I'm going to show you something very important when you are marking out order blocks. Okay, we have a bearish order block, all right, because from here price was pushed towards this direction. So if we pick out that green candle, as I explained earlier, so that's an order block, ladies and gentlemen. All right, but I want you to notice that there is a wide gap between the low of this candle here and the high of this candle. That gap is what we call a fair value gap. Whenever you see it after your order block, whether a bearish or a bullish order block, it is a plus to the strategy I am explaining in this video. Okay, so let me mark it out so you can see what I'm talking about. So I'm talking about the low of that red candle and the high of this third candle. So you have a 3 candle sequence 1, 2, 3, and then you notice that there is a gap between the low of one and the high of the other one here. All right, so that's a fair value gap. That's a region we would expect price to tap into or react from. Okay, price could come to this place, reject, and start moving downwards. Now we have a bullish scenario. We have an order block here from this swing low. The price started moving upwards. All right, so our order block would be this red candle before the bullish move. So say I mark it out. So marking out that order block. All right, and you can see that there is a fair value gap, ladies and gentlemen. Let me zoom this in. You can see that there is a fair value gap between this high and this low. All right, so I'm talking about this gap right here, ladies and gentlemen. You can see there is a gap between that right there. So you can see there is a gap between the high of this candle and the low of this green candle right here. All right, that gap is what we call a fair value gap. So you have your order block down here, and then you have a fair value gap above it. All right, and I want you to notice, all right, I'm going to explain to you the importance of this fair value gap in a jiffy, but notice what happened. Price came to this fair value gap and it rejected from here. What do I mean by that? Price respected that region and started flying up. So sometimes price would reject from a fair value gap. All right, now that you understand what an order block is, let's now look at how to combine it with market structure and the concept of liquidity to predict price. Now let's conceptualize it first before we go to the chart again. Okay, we have a bullish order block here, as you can see, marked out, and we have a break of structure. All right, remember I told you your order block must produce a break of structure. All right, and we have that. Now notice there was an inducement here. After this inducement, I would expect price to move up, come down to sweep the liquidity below this inducement, and after the sweep of the liquidity, I would expect market to start rejecting from this particular zone here, all right, which is your order block. So once you have an order block, this would be your key zone or your point of interest. Okay, after the order block produced a break of structure, wait for a pullback. Some people would enter here sometimes, all right, but it is very risky. When you enter here, notice what the market would do. The market would move up, come down, and grab your money, all right, because you'll be liquidated the moment this market sweeps this liquidity. All right, so a better thing would be to wait for the market to pull back, all right, from this order block that produced the move. All right, after the pullback, wait for the market to come and sweep liquidity. Remember I told you market would always move towards liquidity, so you have to wait for a liquidity sweep. All right, and then once the market gets here and begins to show you a sign that it is about to start moving towards this direction, say you are on the 4 hours time frame, you can go to the 1 hour time frame, refine your strategy, then go down to maybe the 30 minutes or 15 minutes time frame, depending on the kind of trader you are. If you're a day trader, you can just go to the 15 minutes time frame and enter from there. Okay, once the market moves up, you will be making money. Now this would not work all the times, all right, but this is a trading plan that would work most of the times. All right, so you would have more wins than losses using this. There are a number of things I would expect before entering here. First, I would make sure that this order block produced a break of structure. All right, can you see how we're incorporating it with a market structure? 2, I would expect this pullback not to be too far away from this point of interest. All right, it must not be too far away. All right, in fact, the pullback should be about 50% of this initial move. All right, about 50% of this initial move. That would be fine for me. These are things I look out for. And another thing I pay attention to is I sometimes like to see this move, all right, this second move break this level here. If it doesn't break it, I like to see this move at least produce an equal high with this right here. All right, and then I would also like to see a sweep of liquidity. All right, so this low here has to be swept. The liquidity sitting below this level has to be swept. And I also like to see a fair value gap here. All right, it would make it a plus for me. Remember, I explained what a fair value gap is. So if it is present here, that's a plus for me, but it is not compulsory, right? But if it's here, that makes it an A plus setup for me. Now here is a second scenario. I want you to pay attention to another thing I watch out for. All right, as you can see here, we already had an order block here, a bullish order block that led to a push. So we're expecting a retracement. All right, so as I said earlier, the retracement can come like this and then produce an equal high. All right, before pushing to this zone. Can you see? Before pushing to this zone and then rejecting from that zone to the upward direction. So this is okay. So it's not compulsory, it must break structure here, but I like to see it break structure. But if it doesn't, if it produces an equal high, that's fine. That tells me that when the market comes down to sweep this liquidity here, there's a likelihood that the market will still go upwards to sweep the equal high liquidity here. All right, now let's reset. Okay, if the pullback, ladies and gentlemen, enters your order block, it invalidates your order block. All right, we say that your order block has been mitigated. It has tapped into your order block. So if the market moves up, when the market wants to come down again, there is a high likelihood that it is going to violate your point of interest, your order block. So you can see in this scenario, the market moved up, all right, pulled back. This inducement touched your order block. So when you want to use this strategy, you wouldn't want your first pullback to enter your order block or your point of interest. Remember, order block is one of the key zones that we use, not the only key zone. There are other key zones we can use. We can use mitigation blocks, we can use demand zones, we can use a lot of key zones, like even fair value gaps. Market can even respect a fair value gap. I'm going to come to that. All right, so you would always want your pullback not to come close to this. All right, because if it touches this zone is no longer going to be valid. What would you do when this zone is no longer valid? You would look for the next order block below it. Okay, now let's say there is a fair value gap above your point of interest or your order block. In this case, a fair value gap above it like this. All right, so here is what you would be expecting. Sometimes we would expect a pullback to happen and then price to move up, all right, breaking this level, causing a break of structure, and then we would expect the next move, all right, to start rejecting from the fair value gap. It does happen like that sometimes, and then the price of the asset pushes up like this. So sometimes the fair value gap above your order block can reject price. All right, it happens sometimes. All right, but in a situation where this is violated, all right, for example, if price breaches this zone, so your fair value gap is violated, that means you'll be expecting your order block to hold the price. So what you will do will be to watch your order block, all right, go to a lower time frame, watch what happens there, pay attention to the candlestick patterns that are forming at that level, and if the candlestick patterns and other things starts giving you a confluence for an upward move, then you would enter long from that position and price will push up and you take profit. All right, in a bearish setup, ladies and gentlemen, it is pretty much the same thing. you would have your bearish order block here, all right, and you would mark it out. So when price moves down, you would have to first wait for a pullback, an inducement, all right, so that there will be liquidity here to attract the market to come back to, all right. So some people would enter here, which is a wrong decision. Most times the market will move like this and come back again. So the market would come back to the zone, and notice this level has been swept. The liquidity here has been swept. So when market comes here, the next move would be the market would break out in this direction, all right. So this would be the pattern to expect in a bearish situation. Notice there was a break of structure here, had a break of structure, and then once the market comes back, all right, sweeps this structural liquidity in here. So you have structural inducement. The moment this market comes back, sweeps this liquidity here, grabs all the liquidity here, touches this zone, you would start considering shorting the market from here. You go to a lower time frame, all right, and watch the candlestick patterns forming here and seek other confluences around that region, and then you short the market, all right. So as I said earlier, all right, from here you can have the pullback come to this level, push the market to this level. The market can even do all of this, create all these zones, all right. The market can do all of this. Notice what I have here. The market pulled back, created an inducement, pulled back again, created an inducement. We've not had a sweep of liquidity, all right. You will only enter when there is a sweep of liquidity. Notice what has happened, all right. After these equal high liquidities, all right, there was finally a sweep, and then you would have to enter from there, expecting the market to push outwards like this. So ladies and gentlemen, this is the pattern, and the things I like to watch out for would be the same as I pointed out in a bullish case, all right. So this is a bearish case. I would always expect a break of structure, all right. I would always expect a fair value gap, if it is present, above my order block. If a fair value gap is above my order block, I would always expect it to be there. But if it is not, I can still enter the market. But if it's there, that will make it a plus for the trade, ladies and gentlemen. And then of course I would expect a sweep of this liquidity, all right, and then I would expect market to start rejecting from here. You would have to wait to see market reject from here before you enter. There are people who don't wait, of course, they just set this up using a limit order. Now here is a chart example of what I've been explaining. Here we can see that this yellow zone represents our order block, and that's our bearish order block, all right, and below it is a key zone again, which is a fair value gap. You can see the fair value gap between the first red candle and this third red candle. And then of course I do like to see a fair value gap before my key zone, all right. So let me show you the market structure of what is going on here, all right. So we have the market push from that key zone to this low right here, all right, and then from there we had the market retrace, creating this inducement to this level. So we had liquidity, all right, pile up around this region. So notice that that movement led to a break of structure, right, and then from there we had the market push down, all right, to this point. We had the market push down to that point, and that meant we had a break of structure, all right, because that low was taken out as a result of this push right here to this level. And from here, notice what has happened. The market went back to this zone. So notice what is going on. This level now, the liquidity here has been swept, ladies and gentlemen. And what do we expect after liquidity is swept? We expect the market to start reversing. So I expect the market to kind of start moving away from this level, and notice that our fair value gap does look like it's going to reject the price of Bitcoin from here. All right, but if it fails to reject the price of Bitcoin, we've got another key zone, a supply zone, or you might say a bearish order block there. All right, that is most likely going to reject the price of Bitcoin and have Bitcoin sell, all right, move towards the downward direction. Okay, so let's look at a bullish example of what we are discussing. Here we have an order block. This order block here, if I zoom it in, you will see clearly, led to a breakup structure. So the market pushed to this level, but there was an inducement. All right, you can see the inducement pushed this low. Right, so what happened next? The market moved upwards, all right, pushed to this high, leading to a second break of structure. So what are we expecting to happen next? According to the schematics I showed you earlier, we're expecting the market to sweep this level, right, to sweep the liquidity below this level, and you can see the market came right down, went below this level right here, and started buying from this key zone. We can see that the market did push a little bit below this level, right? So if you had your stop loss very close to this level, you would have been stopped out. But a reasonable place to have your stop loss would be somewhere around this level right here. So that would ensure you wouldn't be easily stopped out. But of course, we're trading futures, and the strategy I use does not involve certain stop losses. All right. Now what happened, right? After it pushed a little bit below this level, it came to retest it, and after retesting it, the market started pushing upwards, ladies and gentlemen. Can you see the massive profit? Can you see the massive profit after the second retest of that zone? It was a serious push to the upward direction. Imagine you caught this move. This is the kind of move that turns a small amount of money into thousands of dollars, ladies and gentlemen. So this right here is the strategy. Your job is to look for this everywhere on any financial instrument, on the chart of any financial instrument. Okay, just look for them. They will not always play out, but there is a high chance that when they do show and you are correct, okay, about the schematics, that they might play out. There are even more things to show you. All right, you could have entered this trade with a QMR. There's a QMR here, all right, and this trade would have also triggered. Want to know what the QMR is? Well, make sure you watch the next episode of this video. I'm going to show you how to enter trades with other reference points or key zones, right, including QMRs, supply and demand zones, mitigation blocks, and what have you. So this is for this video. Make sure you share it with your friends and make sure you're subscribed. If you want to watch the full episodes, all the episodes of this course, all right, this is a futures trading course, check the link in the description of this video or go to the playlist section of this channel. Let's go.